This is Ralph Sass, and this is the lecture for Accounting to 11, Chapter 11. And once again, it'll probably be in two parts. So let's go ahead and get started. Chapter 11 deals with the stockholders' equity section of the balance sheet. And the first thing to realize is most of this chapter is going to deal with corporations. We've already dealt with sole proprietorships and partnerships a little bit very early in the semester in chapters like 1 or 2. A corporation is an entity created by law. You need to go to the state in which you're headquartered and go ahead and get incorporated. It's not necessary that you go to that state. You could theoretically go to other states. But especially for small businesses, they generally go to the state and are created in the state where they're headquartered. The beauty of it is that its existence is separate from its owners. So what that means is that your assets, your liabilities, and what have you are separate from the owner. So in the event the company goes broke, they're not going to come take your house, your car, your boat. Okay. Now, ownership can be publicly held or privately held. Most of us think of corporations as big public companies that trade on a stock exchange like Intel or Microsoft or Johnson and Johnson or Kroger. And those are examples of corporations, but corporations can also be privately held, i.e., one person can hold all of the stock in a particular company. So it's entirely possible that the Pizza Pit, which is the business that I own, is entirely owned and all the shares are held by me. The advantages of corporation, and there are a couple of them that I want to talk about here. The big one is the first one listed there, limited personal liability. In the event I own a company and that pizza driver gets in an accident, um, yes, the business may lose money or I may lose the business, but I'm not going to lose my personal house, my car, what have you. Some of the rest of these may or may not necessarily be advantages of incorporation. Transferability of ownership. I can buy Johnson and Johnson stock while I'm sitting here lecturing to you this morning. Very easily, a couple of clicks of a mouse, and I could have bought the shares. If, on the other hand, I own the Pizza Pit and I own all the shares in the Pizza Pit, is it going to be very easy to transfer the ownership of that Pizza Pit? And the answer is no. I'm going to have to find someone else that wants to buy that Pizza Pit. And likewise, professional management. It's easy for Johnson and Johnson to hire professional managers at my local Pizza Pit down the street. Might be a lot more difficult. And finally, continuity of existence. In the event of a corporation, corporations are going to continue even if the owners die. So in the event, the Pizza Pit, I own all the shares in the Pizza Pit. The shares are going to go presumably to my spouse or what have you. But theoretically, at least, the corporation is going to continue separate from myself. The disadvantages and incorporation in textbooks often talk about heavy taxation, and yes and no. If you are a small private incorporated company like the Pizza Pit, you can be taxed as a sole proprietorship. So is it possible that there could be heavier taxation? And the answer is yes. There could be what they call double taxation. But is it also possible to be taxed like an individual? And the answer is also yes. So it's not a huge disadvantage. Greater regulation, maybe. You do have to file some forms every year with your local secretary of state, what have you, for your incorporation, saying that you held an annual meeting, what have you, but it's really not all that much. Cost of formation, does it cost something to form a corporation? The answer is yes. Are there possibly forms today online that you could buy that or and fill out for, 50 bucks? It's possible. I'd suggest you hire an attorney, what have you, and it probably cost you a couple of $1,000s. But if that's the difference between you making it in business and not making it in business, if you can't afford the couple of $1,000s to incorporate, you probably can't afford to be in that business. Each corporation's formed, and I already mentioned this, formed over according to the laws of the state where it's located. So usually you will go to, in our case here in Virginia, you're going to go to Richmond and fill out the forms Obviously, you can send them in. And what you fill out is what are called articles of incorporation, and they kind of set the rules for how you're going to be incorporated. What type of business are you going to be in, and some of those types of things. So they kind of set the ground rules, if you will, for the incorporation. Notice the costs are usually expensed immediately, are not but amortized over 5 years for tax purposes. So once again, this is one of those spots where you're going to kind of keep two sets of records, one for your internal use and then one for use at the IRS. Generally speaking, what happens is the stockholders, the people that own the stock, get the rights to vote. They can vote in person or by proxy. Keep in mind, if I own the Pizza Pit, and I own all the shares, I have all the votes, and I can do pretty much whatever I want, just like a sole proprietorship. In large corporations, they will send you a form once a year, and you can do it online these days and vote for who you want to be the directors. You are also afforded the proportional distribution of dividends. So if there are dividends, and there do not have to be dividends, but if there are dividends, you're going to get your percentage share. Okay, and in the event the business goes bankrupt, theoretically, can you get assets in the liquidation? Yes. However, the reason why the business is being liquidated is probably because they weren't making any money, so there's probably nothing to distribute to the stockholders. Ultimately, stockholders are the ones that own the business. They usually meet once a year. If you ever get a chance, go to an annual meeting. It's kind of an interesting event. I know there are a couple small companies here in Roanoke that have their annual meetings here, and they're just kind of thrilled if you show up, because there aren't a lot of people that show up, and they kind of treat you like kings, like, wow, somebody showed up. What the stockholders do, is they elect the board of directors. And the board of directors then turns around and hires the CEO or president, who then goes ahead and hires the rest of his or her executive staff. Obviously, if it's a small business, I'm the sole shareholder. I vote all my shares, and I am on the board of directors. Usually, you need two people on the board of directors, so usually it's you and a spouse, you and a brother, you and a friend, something like that, and then you appoint yourself or elect yourself president and hire your employees. The functions of the board of directors in big companies is to set corporate policies and procedures. In small businesses, it's pretty much going to be you or I. Okay. Notice there are a couple of interesting things in large corporations. The treasurer is the one that holds the funds. Okay, so the treasurer has access to the checking account, if you will. Notice that the CFO or controller there is the chief accountant. Once again, they are usually separated for purposes of minimizing the chances of theft, what have you. And the corporate secretary is the contractual and legal representative. They're usually the ones that are responsible for making sure that the annual meetings are properly recorded, and any minutes or anything that has to be provided to the state is provided to the state. Couple of rules for corporations. They do have to follow GAAP, generally accepted accounting principles, which is what we've been talking about all semester. Publicly owned companies have to have their financial statements audited by an independent CPA. Private corporations do not, although a lot of times if you want to get a loan or something like that, it is in your best interest to have a CPA look at them, but you don't have to worry about, they don't have to be audited. You also, if you're a privately owned company, you don't have to submit your financials to the SEC for review. You don't have to comply with federal securities laws to that extent. If you're publicly owned, however, you do. What happens when you buy a share of stock on a stock exchange, whatever, there is a stock transfer agent or a stock registrar. The corporation does not keep track of who owns their shares. There are a couple of big banks in this country that basically are the stock transfer agents and stock registrars for all publicly owned companies. So who knows who the shareholders are? Those banks. Okay, I already mentioned that they meet once a year. Each unit of ownership is called a share of stock. Quick note, when you buy a share, you can buy one share. although that's not a traditional what we call a round lot. A round lot is 100 shares. So usually you buy shares in 100 lot increments. Stock certificates are proof that the shareholder owns the shares. Today, you do not want to see a stock certificate. To get a stock certificate and to trade a stock certificate is very difficult. Is the last bullet there mentions when the stock is sold, the stockholder signs a transfer endorsement on the back of the stock certificate and has to send it in. Bottom line, you don't want to see a stock certificate. If you go into a safe deposit box for grandma or your parents and see one, usually it's because they're deceased, and let me just tell you, you're going to have a lot of work to do to get that shares transferred. Usually today, stock is held in what we call street name, so it's held by the broker, and then it's very easy to transfer. So you really don't want to see a stock certificate today. Old school, if your parents, grandparents, whatever, you'll probably find one, and basically what it means is that you're going to have a lot of work to go ahead and transfer that stock. Stockholders' equity, and we've seen this kind of all semester, although we haven't talked about it specifically, can be increased in one of two ways. One is the owners of the company or the stakeholders, or the company can sell additional shares, or alternatively, the company can retain their profits, which is called retained earnings. And if you remember back to closing entries back in Chapter 5, we credited or debited retained earnings for the net income or net loss. So that's how stockholders' equity can be increased. When you fill out the articles of incorporation, you will tell the state how many shares are authorized, and it'll be some big number, okay? Maybe if it's a private company, maybe 20,000 shares or something, which are the maximum number of shares that can be sold. And then what happens is, of those authorized shares, some are going to be issued and some are going to be unissued. So what you're going to do is maybe authorize 20,000 shares and say, I'm going to issue 10,000 and keep the other 10,000 as unissued shares in case I need to raise more capital, sell more stock, what have you. Usually they're sold through an underwriter, which is usually a large stockbroker or bank that will proceed to sell them for you. It is an expensive endeavor, but if you need to raise cash, it is an important one. Okay. What happens is then the authorized shares, some of those shares are typically outstanding, and in some cases the company owns or buys some of those shares back. Okay, notice what it says under treasury shares. Treasury shares are issued shares that have been reacquired by the company. What the companies sometimes do is, especially public companies, is they will issue 1,000,000 shares or what have you, and they'll buy 20,000 back. The reason why they end up buying those 20,000 back, what we call treasury shares, is because they are going to use that to compensate perhaps the president or vice president or what have you for outstanding service. So a lot of times they'll buy those shares so that they can redistribute them to individuals that work at the company. Sometimes they might buy them to sell later at a higher price, although that I've found is very rare. What's much more likely to happen is they buy those shares to distribute to employees of the company as some sort of an incentive plan. Old school companies would issue stock with what they called par value. It was just an arbitrary amount, so they'd set it up at $10 or $5, what have you. It comes out of early stockholding days, comes out of the Depression, comes out of even some of the robber barons going back to the late 1800s, and they would issue shares with no par value and then run the company into the ground. And so par value at the time was created so that owner's equity, they couldn't pay dividends to reduce owner's equity below the par value. Today, you'll find a lot of companies still have a small par value, maybe 5 cents or 10 cents or something like that. It might be due to stock splits, which we'll talk about in the next video. But there are also a lot of companies that just issue what they call no par stock or no par stock. So par value stock, we'll talk about in a couple of minutes here. No par stock, it means that all the proceeds are credited to common stock. So if I have no par stock and I sell the stock for 20 bucks a share, all of that is going to go into common stock. Okay, if it is stated value common stock, which is extremely rare, okay, it's going to be treated like par value common stock, which I'm going to talk about here in a minute. Okay, so we're going to take a look at par value common stock. So notice what happens in this. We have to record the cash as received. We saw this going all the way back to chapter 2 and 3 in the semester. And the number of shares issued times the par value is going to go into the common stock account, and the remainder is going to be put into an account which we call additional paid-in capital. And if you look at 99% of all large companies, they will have both a common stock account and an additional paid-in capital account. So let's take a quick look. Suppose that a corporation issues 10,000 shares, $2 par, and they sell it at $8 per share. You do not need to sell your stock at the par value. In fact, that par value is just some made up number, and 99.9% of the time, stock is going to be sold for some amount in excess of its par value. So notice our journal entry here. They've issued 10,000 shares at $2 per share par value, so 20,000 will go into common stock. But I've collected 80 grand in cash. $8 times 10,000 shares is 80 grand in cash. So the additional 60,000, debits and credits still have to be equal, is into an account called additional paid-in capital. And in the event we were looking at the owner's equity section of the balance sheet, it would look something like this. And you go take a look at any publicly traded company, and they'll all have one that looks very similar to this. They'll have a common stock, $2 par. Notice it tells you 50,000 shares are authorized, 10,000 are issued and outstanding. So that's where that 20 grand comes. Then the additional paid-in capital is 60 grand for a total paid-in capital of 80 grand. And then that retained earnings in this example is 150 grand. Where'd they get that? They just made up the number. Okay. And that is the total of all their profits and losses since they've been in business. And their total stockholders' equity in this case is 230 grand. I am going to go ahead and stop the lecture for this part of chapter, this part of the chapter, and we will continue it with the second part of the lecture for chapter 11.